Hello, everyone. Welcome back to FinancePath. What if I told you that during one of the most politically chaotic and economically uncertain times in recent memory, when fear dominates the headlines and confusion clouds every conversation, the US stock market didn't collapse, it reached new heights? It sounds unbelievable, but it's true. Right now, the S&P 500, the key index that tracks the performance of 500 of America's most powerful companies, has quietly surged to an all-time record high. No fireworks, no celebrations, just a steady, surprising climb that seems to defy everything the news is telling us. Since President Trump began his second term in January 2025, we've seen headline after headline about aggressive tariffs, rising inflation, fears of job market instability, and debates over soaring national debt. Many economists have warned of an oncoming recession. Fear has spread like wildfire, causing average investors to hesitate, panic, or even exit the market altogether. And yet, the market is not falling. It's rising. How is this possible? And more importantly, what does it mean for your money? In this video, we're going to break it all down. We'll look past the noise to uncover the real story behind the market's strength, explore why fear in the market often signals opportunity, and share powerful lessons every investor should understand when the world feels uncertain. Because if there's one truth that history keeps teaching us, it's this: the louder the fear, the bigger the opportunity. Since Donald Trump began his second term on January 20th, 2025, the US has seen an almost non-stop wave of headlines, each more dramatic than the last. The political noise is loud, the economic anxiety is louder. Then came April 2nd, a day Trump proudly named Liberation Day, a signal of his aggressive return to hardline trade policies. On that day, the administration announced sweeping tariffs on dozens of countries running trade deficits with the US, including major global players like China, Mexico, Canada, and the European Union. The goal? In Trump's words, to protect American benefits and workers and force other nations to the table for what he calls fairer trade deals. But almost immediately, the reaction was explosive. Economists warned that these tariffs would be passed down the supply chain, from manufacturers to retailers to, ultimately, US households. That means higher prices at grocery stores, online retailers, and gas stations. Businesses braced for thinner profit margins and rising uncertainty. News anchors spoke of possible factory shutdowns. Talk of inflation, layoffs, and even a looming recession dominated financial headlines. Fear swept through Wall Street and Main Street alike. The chaos also led to a dramatic decline in the stock market and a wave of intense correction. But then something strange happened. The S&P 500, the index that reflects the health of America's largest public companies, didn't collapse. In fact, after hovering for a while in February 2025, a staggering dip in March 2025, it began to stabilize in April 2025 after the tariffs announcement. And then, it climbed. Slowly, quietly, steadily. This wasn't a fluke. It was a sign. Even in the middle of policy shockwaves and endless commentary, the market was sending a different message. One of resilience. It's almost as if the market, not the headlines, was whispering to those who listened. We've seen storms before. This isn't the end. This is part of the process. So why is that happening? Why does the market behave this way during chaos? That's precisely what we'll explore next. When the tariffs were announced in April 2025, many economists and market analysts didn't hesitate. They sounded the alarm bells loud and clear. Some of their warnings made sense. After all, tariffs can lead to higher prices on imported goods, stress global supply chains, and trigger retaliatory actions from other countries. These impacts aren't just theory, they've happened before. But here's where many of them missed the mark. They underestimated one critical factor: the resilience of the US economy. More importantly, they ignored something just as powerful: the mindset of long-term investors. While headlines shouted about crisis and collapse, seasoned investors kept buying. They weren't distracted by daily panic. They were focused on the fundamentals, on the strength of American companies, on future earnings, and on long-term growth. And in the background, real progress was happening. The US and the UK reached a new tariff agreement. Vietnam, after weeks of negotiation, concluded a trade deal with the US. Even China, which initially fought back with its own tariffs, agreed to a temporary trade war truce, a major signal of cooperation. These developments didn't make front-page news for long, but the market noticed. Markets don't need perfection, they just need direction. And with each agreement, a bit more clarity emerged. That clarity, even in a tense environment, gave institutional investors enough confidence to stay the course. While many so-called experts continued to debate on talk shows, the market quietly adjusted and moved forward. That quiet movement would soon speak volumes. While President Trump continued to push for bold and immediate action to stimulate the economy, including a public campaign urging the Federal Reserve to slash interest rates, the Fed didn't budge. They said no. At first glance, that decision may have looked like resistance to the U.S. economic growth, but in reality, it was a careful and calculated move rooted in long-term thinking. The Federal Reserve wasn't ignoring the pressure, they were just protecting the foundation. They saw the warning signs: rising tariffs, increasing input costs, new tax and spending policies potentially widening the fiscal deficit, and an underlying risk of inflation accelerating beyond control, which could happen in the second half of the year. Cutting interest rates at that moment might have provided a short-term sugar rush to the economy, but at the risk of overheating financial markets or devaluing the dollar in the long run. Instead, the Fed chose caution. They chose independence, and that choice sent a powerful message, especially to institutional investors. The U.S. financial system is still governed by rules, not reactionary politics. Markets crave consistency. When they see that the Fed won't bend to short-term political pressure, they gain confidence. It shows that the long-term structure of the U.S. economy remains intact, even amid political turbulence. This steady hand at the wheel reminded the world that the Federal Reserve still plays its traditional role, the guardian of the U.S. economy's stability, and that reassurance matters more than any headline. On July 4, 2025, President Trump signed into law what he proudly called the One Big Beautiful Bill after the Congress passed its vote for the bill on July 3, 2025, a sweeping tax cut and spending package aimed at delivering what he sees as the next chapter of American greatness. It includes bold tax cuts, significant boosts in defense and border security funding, and even a plan to raise the debt ceiling by several $trillions to keep the government running. From CNN, we can know that the bill would increase the deficit by about $3.4 trillion over the next decade, according to the CBO. But here's where the division begins. Supporters of the bill call it a powerful growth engine, claiming the expanded child tax credit, tax relief for workers, and billions poured into defense, infrastructure, and industrial projects will create jobs, strengthen national security, and signal confidence to businesses. Critics, on the other hand, call it dangerous. They warn the bill guts critical safety nets like Medicaid and SNAP, imposes new restrictions that could harm low-income families, and eliminates clean energy and EV tax credits, rolling back years of environmental progress. To them, the bill favors short-term political wins over long-term sustainability. But the market doesn't weigh morality. It measures momentum. When the bill passed, the economic indicators, like factory output, consumer confidence, and job postings, didn't collapse. In fact, many of them stayed steady or slightly improved. The New York Fed's survey of consumer expectations for June, released July 8th, showed that consumers are more optimistic about price increases, their job security, and their own personal finances. The labor market is more robust than anticipated. The Labor Department said that 147,000 jobs were created in June, while analysts polled by FactSet expected the creation of 115,000 jobs for June. The unemployment rate was unexpectedly down too. Meanwhile, the department reported separately that employers posted 7.8 million job vacancies in May, compared to 7.4 million in April. Economists had expected the figure to go down to 7.3 million. Once again, Wall Street focused not on politics but on the direction of movement. Now let's turn our attention to the main character of this unfolding story, the S&P 500. At the start of 2025, with new tariffs, political tension, and media noise swirling, the S&P 500 took a sharp dip. Investor sentiment was rattled. Talk of a recession grew louder. Headlines warned of rising inflation, global uncertainty, and financial instability. It felt like the perfect storm. And yet, just a few months later, by July, the index reached a brand new all-time high. How is that even possible? This wasn't luck. It was investor psychology in motion. When fear dominates the headlines, retail investors, everyday people, often react emotionally, pulling money out of the market. But behind the scenes, institutional investors, the professionals managing billions, usually do the opposite. They know that fear creates discounts. They don't panic when the market dips. They prepare. They look at long-term trends, historical patterns, and strong fundamentals, and when prices fall due to panic, they are happy to buy. This is what's often called a blood in the streets moment. Not in a violent sense, but in an emotional one, when the market feels hopeless, but quietly begins offering opportunity to those who stay calm. And this pattern isn't new. It has played out again and again, through financial crises, political shifts, and global uncertainty. The market rises not because fear disappears, but because smart money acts while others hesitate. That's exactly what we just witnessed happening right now. So, what should we take away from all of this? The most important lesson is this: the stock market doesn't move based on what people feel. It moves based on what money does. Yes, headlines shape emotions, but price movements are driven by behavior, and behavior often follows a predictable pattern. When fear runs wild, most people act emotionally. They sell too early, hold too much cash, and wait for the perfect time to invest, which never comes. Meanwhile, those who study history, understand fundamentals, and remain calm often step in during those fearful moments and position themselves for long-term gains. The media may paint a picture of doom, but smart investors know the market has always found a way forward. Just think about what the US economy has survived: 2 world wars, the Great Depression, the oil crisis and stagflation of the 1970s, Black Monday in 1987, the dot-com bubble burst, the 2008 financial crisis, a global pandemic in 2020, and still, the S&P 500, once trading under 20 points in the 1950s, has now surpassed 6,000. That kind of growth isn't by accident. It's a reflection of consistent innovation, economic adaptability, and investor faith in the long-term value of American enterprise. Yes, recessions happen, dips happen, but they don't stop the upward trend of the US economy. They are part of the trend. When you focus on the headlines, you may miss the real story. But when you focus on the long-term trajectory of the US economy, you'll see what experienced investors see: not panic, but progress. So now comes the practical question. What should you do in a world full of noise, fear, and confusion? Here's what I believe, and what experience consistently shows. Tune out the panic. Pay attention to the fundamentals, and make your decisions with discipline, not emotion. Yes, tariffs can shake global trade. Yes, inflation may rise and fall. And yes, political drama, especially in today's world, might never stop. However, none of these events have ever permanently disrupted the US economic development uptrend and halted the stock market moving upward. Not even close. If history teaches us anything, it's this: every market dip is not the end. It's often the beginning of a new opportunity. And when the S&P 500 rises in the face of fear, like we just witnessed, that's your signal. It's proof that even in uncertain times, smart money doesn't sit on the sidelines. It moves quietly, confidently, and with purpose. So the next time you see the market pull back, don't let headlines drive your decision. Don't act out of fear. Don't chase perfection or wait for everything to be safe again, because by then, the opportunity may have passed. Instead, stay calm, stay invested, stick to your long-term plan. Because in the end, the US economy is not defined by noise. It's powered by innovation, resilience, and growth. And that is the engine that builds real wealth over time. If you've ever felt anxious during volatile times, know this: you're not alone. But fear is not a strategy, discipline is. If you enjoyed this video, give it a like and subscribe to FinancePath for more simplified, beginner-friendly investing tips. Please let me know in the comments, did this video help you rethink your fear in the market? And how do you handle uncertainty when investing? Thanks for watching. I'll see you in the next one. And remember, where others see panic, you can find your path.